They didn't send a warning. They didn't ask permission. They just moved. Switzerland quietly dropped its interest rate to zero. No press, no warning, no explanation. And in that one quiet move, they may have just triggered the next phase of the global financial collapse. Because this wasn't a domestic decision. This was a signal, and not for Switzerland. It was for the world. The S&B isn't like other central banks. They don't cut rates to look proactive. They cut when they feel threatened. So the question becomes, what exactly did they see? Why would the world's most trusted and discreet central bank suddenly slam the panic button before anyone else even flinched? Because behind the curtain, the landing has already failed. And Switzerland just pulled the first emergency lever. Let's break this open. On June 19, 2025, the Swiss National Bank cut its key rate to 0%, down from 0.25%. This marks their sixth consecutive cut, a streak unmatched by any major central bank this year. It's not inflation that's scaring them, it's something much worse: debt stress, liquidity cracks, and confidence loss. The S&B operates at the intersection of elite capital, offshore wealth, and systemic liquidity. If they're cutting rates into a tightening global cycle, it means they're already watching the ice crack beneath their feet. And when a bank like Switzerland moves quietly, it's not because they're early, it's because they're late. They're reacting to something that already broke. The world's financial system is now sitting on top of over $315 trillion in debt, more than 330% of global GDP, according to the Institute of International Finance. That number alone should terrify anyone with a checking account. But here's what no one's talking about. This isn't just high debt, it's expensive debt. After 2 years of elevated interest rates, the global financial system is now carrying that $315 trillion load at the highest cost in modern history. It's not just emerging markets, it's not just small companies, it's entire nations, the US, the UK, France, Japan, who are now bleeding interest payments at unsustainable rates. That's why Switzerland made their move first, not out of leadership, but out of necessity. Because if you know anything about how capital moves in moments of fear, you know Switzerland sees the signal before it hits the headlines. Why? Because elite money parks itself there before the system collapses. And right now, that money is getting nervous. According to internal reports from UBS and Credit Suisse's legacy desk, Swiss capital outflows rose sharply in Q2, particularly from institutional accounts. This isn't noise, this is insider retreat. And when the smartest money in the room starts pulling back, the quietest central bank in the world starts cutting. That's not speculation, that's self-preservation. Let's look at the United States as of today, June 25th, 2025. The U.S. national debt stands at $36.6 trillion. The annual interest bill is approaching $1.2 trillion, which now exceeds the defense budget. Think about that. The U.S. spends more money servicing debt than it does defending the entire country. And yet the Fed can't cut rates, not without reigniting inflation and destroying credibility. They're stuck, and so is Europe, and so is Japan, which is exactly why Switzerland is stepping out of the game early. They're not making a move, they're making an exit, while the rest of the world still clings to denial. Because whether the media says it or not, the next sovereign default isn't a question of if, it's when. And every bond desk knows it. Behind closed doors, global funds are repositioning hard. They're not buying the soft landing narrative. They're watching the collateral system crack. Just last week, the World Bank revised global GDP forecast downward for the third time this year, citing structural debt concerns and sluggish capital formation. Meanwhile, delinquencies are rising in U.S. consumer credit, corporate bankruptcies are accelerating, and real estate markets in China and Germany are flashing systemic risk. It's all happening beneath the surface, but it's real. And Switzerland just became the first to blink. Let's talk about gold. When the S&B cut rates, gold futures spiked above $3,320 an ounce, a move that contradicts normal expectations. Why? Because in a normal market, rate cuts boost currencies like the franc. But this wasn't a growth cut, it was a fear cut, and capital always knows the difference. Since the S&B's move, the Swiss franc has weakened, which almost never happens when fear is low. At the same time, capital flows into short-term U.S. treasuries have increased, while volume in Bitcoin and Ethereum derivatives has quietly ticked higher, a sign that smart money is searching for exit ramps. But if you wait until the Fed cuts or until CNN finally admits the bond market is broken, it's too late. The smart money will already be gone. Because when confidence dies, everything else dies with it. Liquidity, credit, investment, trust. And without trust, no amount of stimulus will bring it back. So what does that mean for you? It means the system just blinked, and only a few people noticed. If you're holding debt-heavy assets, get lean. If you're overexposed to low liquidity plays, cut risk. If you're not sitting on 3 to 6 months of cash reserves, fix that immediately. Because in a crisis of confidence, the best return isn't yield, it's survival. Start thinking in terms of asset protection, not just asset growth. That means hard assets like gold and silver, strategic exposure to decentralized infrastructure, high liquidity safe havens, and above all, optionality. Because when systems fail, those who have options survive. Those who don't get wiped out. Switzerland just told us everything we need to know. They're no longer playing the game, they're exiting the table. And if you want to avoid becoming collateral damage in the next financial firestorm, you better start moving too. Because the silence from other central banks, that's not calm, that's paralysis. And when the paralysis breaks, it will break fast. Don't wait for permission. Don't wait for confirmation. The first move already happened. The clock has started. You either react early or get buried late. And here's the truth. Most people can't stomach. Every time a central bank pretends nothing's wrong, the clock accelerates. Every delay, every fake reassurance, every manipulated headline, it all speeds up the inevitable. You don't beat the system by trusting it. You beat it by seeing through it and moving before it moves on you. And there's one more thing they won't tell you. The next crisis won't look like 2008. There won't be one big crash on one dramatic day. It'll be a series of silent withdrawals, quiet policy pivots, and closed-door emergency meetings. It'll be announced with liquidity vanishing, not headlines. Pensions will quietly stop dispersing on time. Banks will reduce ATM withdrawal limits. Bond auctions will begin to fail quietly until suddenly they don't clear at all. And when the shock finally hits the surface, it will already be too late to reposition. That's why Switzerland didn't wait. That's why the insiders are already moving. And that's why you're here, watching this instead of getting blindsided like the masses. We are at the edge of the quiet unraveling, and you still have time, but only if you use it now. If you're serious about protecting your wealth before the next trigger event, this is your chance. Subscribe to Wealth Signal and get ahead of the next global rupture before it's announced. This isn't just about what they're doing. It's about what they're not saying and what that silence really costs when the system breaks.